The United States is technically bankrupt because it cannot pay for what it has promised. So either we're going to have to inflate our way out of this, which is what I expect that's going to happen. We're certainly not going to pay off the debt. That's for darn sure. It's completely impossible. So it's a pretty bad scene.
For a limited time, the Austrian Mint and SD Bullion are offering you a Silver Philharmonic Buy 19, Get 1 Free Coin deal. Officially issued by this storied 825-year-old European bullion mint. These famous European silver bullion products come packaged complete in protective sealed Austrian Mint tubes containing 20 coins apiece, or in bulk sealed Austrian Mint cases containing 500 troy ounces in each. These guaranteed 1 troy ounce Austrian Philharmonics are official European legal tender silver coins. Each is comprised with a minimum 0.999 fine silver bullion content. Austrian Philharmonic bullion coins qualify for silver IRAs, making them an excellent choice for tax-deferred, long-term bullion savings. Discreetly shipped, fully insured to SD Bullion customers' doors and non-bank vaults. Don't delay. This free silver Austrian Philharmonic bullion coin deal will end soon.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Jerry Robinson, Christian economist from FollowTheMoney.com. Jerry, thank you so much for joining us today.
Oh, sure. Great to be here, Elijah.
All right. Now, I was actually recently reading a Business Insider article, and it was saying that the global economy is in its worst shape since 2009. And really, it was talking about different economies around the world and how, some are worse than others. But really, when there's a downturn in one, it can affect a lot of others as well. So can you kind of share with our viewers your view of where the global economy is right now? It seems like some people are saying that it is in the worst shape since the last major recession.
Well, I would say, Elijah, that we've certainly seen a deceleration in China. If you can really complain about 6% GDP growth per year, it's difficult to complain about that when you're living in the United States, where you have a less than 3% GDP growth and much lower as we go forward with forecasts and projections. So, but China certainly has seen a deceleration. Also, Europe has been stymied with some pretty, low growth and even inflation figures. And that's caused recently the ECB back at the beginning of March to make a big U-turn. They were just 3 months out of the gate from ending their last major round of monetary easing. And then they announced a brand new one just at the beginning of March. So they've started, QE all over again, a new round of cheap loans to European banks.
Now, with respect to how different economies can affect other economies, what is your perspective on how, it could affect the United States?
Well, there's no doubt. I mean, we're in a super interconnected world today, and the United States has been, I think, fairly insulated in some ways, especially since the Trump administration began, as we've been pulling back from some of our typical alliances. The slowdown that we've seen in China, the slowdown we've seen in Europe, it doesn't bode well for the United States. But again, I think it all depends on what data you've been looking at. Here in the United States, things have not really been growing much at all. I mean, as far as the economy goes, I think the main thing that, economists can lie with numbers. And I think that's really what's been happening here. So here in the United States, there's been a lot of pointing at the stock market, right? Look at the stock market go up. That must mean that the economy's great. We've also been we've seen the government pointing at the jobless figures and saying that's great. But take a look at what happened to the yield curve just last Friday, where we saw this leading recession indicator, flash a warning for the first time since 2007. So we have, very likely not only a slowdown in Europe, not only a slowdown in China, but now economic reality setting in here in the United States, which suggests that we are in for, a recession at some point, maybe over the next 3 to 24 months. However, the former Fed chair, Janet Yellen, recently stated, when asked about this recently inverted yield curve, she was asked if this meant that we were going to see a recession here in the United States. And she basically said, no, it means we're going to see a slashing of interest rates. And I think that's what the Fed is going to do. And in fact, if you take a look at the overall expectation of the rates going forward, I was looking at the federal funds futures rates over the weekend, and they actually suggest that about a 60% of investors believe that we're actually going to see a rate cut in 2019, whereas in November of last year, that number was just 11%. In fact, it was even just a month ago, it was just 11%. So we've seen a massive shift in sentiment. So yeah, I mean, Europe's not in a great shape, especially with Brexit. What a basket case that is, where you have Britain who says, hey, let's leave the EU, and then after they decide to do that, then they decide, well, we're not sure if we want to or not, and how are they going to untangle themselves? We're really in flux. I think for the average investor who is out there watching all of this, it's really good to be diversified now. And it's certainly good to have a core position in precious metals, because in this environment, they're going to be the primary beneficiary of all of these poor monetary and fiscal policies that are leading us on this road to quite frankly, just to insolvency and to bankruptcy. We have no plan to pay off all of these debts, Elijah. In fact, we have a spending plan, but we don't have a debt repayment plan. The Trump administration just released its budget for a better America, ironically, that showed that for the year 2020, fiscal year 2020, the Trump administration wants to spend $4.7 trillion over the next, for the whole fiscal year of 2020. And $4.7 trillion, I think that's a lot of money for 1 year. And they plan on taking in $3.6 trillion in revenue during that fiscal year, which means they're going to saddle the United States of America with another $1 trillion deficit. That's on top of the 2019 $1 trillion deficit we already had. That's in addition to the $1 trillion deficit that they are projecting for 2021. That's in addition to the $1 trillion deficit the Trump administration is projecting for 2022. They continue to saddle not only us, but future generations with excessive amounts of debt that they have no plan to pay this debt. They have no plan to pay it off. And they think they're going to keep cheap interest rates so that they're not going to have to, worry about high interest payments. And that all of this is completely a house of cards. I wrote a book called Bankruptcy of Our Nation. I meant it. The United States is technically bankrupt because it cannot pay for what it has promised. So either we're going to have to inflate our way out of this, which is what I expect that's going to happen. We're certainly not going to pay off the debt. That's for darn sure. It's completely impossible. So it's a pretty bad scene.
Now, you mentioned the yield curve. If you could expand on that a bit, how there's an inversion with the 3-month Treasury and the 10-year Treasury. Now, you've talked about on your YouTube channel, actually, how this has kind of been, in the past, has preceded a recession anywhere from about 12 to 24 months beforehand. So do you think this is going to happen, that we're going to see a recession because, we're seeing the signs of that? Or will the Fed be able to maybe even lower interest rates and protect us from that?
Yeah, that's the big question. So this yield curve inversion is it's pretty significant. It's kind of a geeky thing to look at. I mean, it's not something that people talk about all the time, but basically whenever you have a flood of demand for the long bonds, and that would be 10-year Treasuries, even 30 years, but let's focus on the 10-year because that's what's in focus here. The 10-year Treasury, it finally dipped below the 3-month Treasury or the T-bill yield. And the 3-month yield is kind of considered the risk-free rate. It's kind of considered, it's just a very, very important rate that many people turn to. And it's very attached to what the Federal Reserve is doing, the rates that it's setting. And the fact that the 10-year yield, think about it, Elijah, if you were going to loan somebody money for 3 months or you were going to loan them money for 10 years, which one would you expect to have a higher interest rate? Well, obviously, the one for 10 years because there's more risk involved. I mean, anything could happen. And so the fact that rate has fallen below the 3-month rate is really quite staggering. It's really quite staggering. And the last time this happened was back in 2007. And this inversion of the yield curve has preceded the last 7 recessions in America. So it's very predictive of a potential recession here. The only caveat that should be mentioned is the fact that, it just fell below that rate. That inversion has lasted now for a couple of days. Typically, you want to see a period of about a quarter where you actually see that holding. So the fact that it dipped below, we could get a knee-jerk move right back above that rate, and maybe it's just a blip on the screen. But it appears to be staying. It appears to be lingering. And the primary reason is because the Federal Reserve has signaled that it's not going to raise rates anymore. And much of the expansion that we have been, perceiving here has been due to the fact that the Fed is going to raise rates again and again. And that's why we've been seeing those rates kind of rising. And so now in this new environment where the Fed has just totally changed its game, totally did a U-turn, now we're seeing those longer rates coming down. And so, yes, it is possible that we will see a recession. In fact, it's very, very likely based upon this event if it remains and lingers. But again, as Janet Yellen had stated, this inverted yield curve doesn't necessarily mean we have to have a recession because the Fed can always cut rates. And again, I think that's probably what's going to happen. So we'll see if this recession indicator, which has proven to be correct the last 7 times, will be correct again here. Again, the Fed, we fully expect to step in, though.
And what are some of the ways that people can take action to protect themselves?
Well, they can first, be thinking about diversification. First of all, one of the things that when I take a look at how we've kind of diversified our own investments, we've really positioned ourselves for future trends. We expect China to continue growing at a much faster pace than the United States. So, China right now is the largest economy in the world, based upon GDP on a PPP basis. That is real purchasing power. Forget the nominal GDP that the U.S. likes to use. Instead, focus upon the actual real purchasing power. And if you take a look at China, they are the largest economy, and they've been that way for 5 years. And in probably the next 2 to 5 years, they're going to surpass us on a nominal basis. And that's whenever the majority of Americans are going to wake up. That's when they're going to wake up and realize, hey, China really isn't going away. China's been here for 5,000-6,000 years, and they still aren't going away. And so what we have done is we've diversified. We certainly have some exposure, not just to United States equities, but also outside, emerging markets. So I think first of all is to be a little less U.S. centric in your mindset if you have a longer term time horizon. Another thing you can do certainly is to diversify your income. We've talked about that many times on your broadcast, and I would encourage people who are out there listening to this to go to our website, followthemoney.com/5 levels, and there we have listed out the 5 levels of financial freedom that myself and my wife have used to break free financially. I used to work at a job I didn't like. I used to, live paycheck to paycheck. I used to be in debt. I used to, live in the city and kind of live in a way that I really didn't want to live. And over time, I've been able to escape the rat race. I've been able to go out and buy my own piece of property with, water supply on it. I've been able to, grow a garden, teach my children how to farm. I'm trying to get off the grid, moving towards solar for energy. We've got ourselves about 75% off the grid now in our property, and we've kind of moved out of the city. And that's what we decided to do. But we decided to take action for ourselves, and we've shared on our website exactly how we went about that. Followthemoney.com/5 levels. We've laid it all out there. It's been a big labor of love, and I would encourage anybody who's interested in that to go check that out.
Definitely. And I guess before we let you go, Jerry, did you want to share with the viewers any last thoughts you had? And just thank you so much for your time today. And where can they find you online?
Yeah. Well, final thoughts again, just take action and protect yourself. There's such a temptation to pay attention to all the press releases that are coming out, and for you to, pay attention to the corporate press releases and, get outraged about something every single day. And to take action would be to, focus upon making sure that you have your plan in place. Do you have a financial advisor? Do you have a will? Do you have guardianship for your kids? Do you have insurance? Are you properly insured? Do you have you diversified your savings? Do you have savings? Do you have enough savings to get you by if something happens to you? Do you have diversified investments? Do you have diversified income? Are you dependent upon one stream of income and only one stream? So these are the kinds of questions that we should be asking ourselves, not what did, so-and-so say today, or what should we be outraged by today? That's what social media feeds. Now, for those people who want to find out more about us, I would say go to followthemoney.com. We have lots of free stuff there. We have a free podcast we do. We interview a lot of the top minds in economics and in business. But on top of that, we also have a free newsletter that we put out that you were referencing there, our Robinson report we put out each weekend for free. And we have lots of other free stuff on our website, the 5 levels of financial freedom and many other things. So I would just go to followthemoney.com. And if you want to receive our free newsletter, just type in your email address in the email form, and we'll make sure you get that each and every weekend.
All right. Once again, Jerry Robinson, thank you so much for your time today.
My pleasure. God bless you, my friend.
You too.